Good morning, all, and happy Thanksgiving. My name's Veteran, and I'm with Independent Traders Guild, ITG, and just going to kind of do a year in review this morning. And all I've got in front of us is S&P futures chart. It's a daily chart, and the red line is the 200-day moving average. It's a 200-day simple moving average, and we're just going to start from the high of the year and kind of do a deep dive into where we've been, where we're going to go, and again, nothing scripted out for the video, so I'm just going to talk and teach, and maybe it'll bless some people on Thanksgiving. So here we are. Everybody remembers we put in a new high somewhere in early January. Nasdaq was late December, actually in November, and then a lower high in December. That's another video that I probably need to do. So you can see that from January, obviously we sold off. We got down to the 200-day moving average. Now, this line for people becomes important is because you got to understand the character of the overall market globally and the economy and what's transpiring. Um, in the event that we're into a rising interest rate environment, the 200-day moving average has substantially different meaning. And I'm going to review a little bit of history too as we go through this. And I promise to keep it as short as possible, but my clan knows that this brother here loves to talk. Um, in a bull market, you're buying the 200-day moving average all the time. What I don't have in here is a 50-day moving average. That becomes important. So, as a former fund manager, portfolio manager, and owner of a hedge fund, you'll use the 50-day and the 200-day moving average often. I only have the 200-day. On your 401ks and those kind of things, this is where below this level, traditionally you're doing good if you're start to dollar cost average DCA underneath the 200-day moving average because you're going to get a fair price. What it prevents you from ever buying up here and being completely trapped, buying at 4,700, 4,800 all-time high. You'll see big red candles on the way down. You don't want to faint. Big red long daily bodies where the candle body, not necessarily the wick to wick, but the top of the candle, the bottom of the candle. Here's the body open and here's the close. As long as these are long on a daily chart, there's no fear of immediate reversals. Here you've got 3 down, 3 up, and there's candlestick patterns for all this stuff. From the 12th of January, our last up bar, we had a series of red bars that took us down to the 50-day moving average. And then this becomes critical as you see the first green bar, again, the open, the high, the low, and the close. And you see the long wicks. And the long wicks in a candlestick pattern, the long wicks tells us there's an exhaustion of sellers. There's a lot of auctioning going on here, but the fair price is usually typically in the body of the candle. So that's a sign that some of the sell pressure is starting to alleviate, starting to disappear. And so from this, you're looking at this line, and again, the 200-day moving average, you can see institutions, there's mutual funds that they only want to hold certain securities when we're above here. There's certain securities that'll go more into large cap growth as the S&P gets above the 200-day moving average. They'll reallocate below it and they'll rebalance back into it. So not to get into specifics here, but as we move forward, we got back above it. And we came back and tested it, and that's typically what happens at the major levels, right? We break above it, we come back and retest it, and we launch. Now, the second launch becomes important is because we didn't make a new swing high. So this becomes important right here is because we didn't get over the February 2 on the 9th of February. So a week later, we hit a double top here, and we sold back off. Now, selling back off, I'm looking at this red line to help me make some long-term investment decisions. When you get below this long-term investment decision here, now you got to go back to, we draw in January 4th to this peak. It would be this peak, but it would be under this one. So January 4th to this peak, this becomes our first trend line of the year. And now if we'll extend it to the right, Um, we now have a trend line that says, I'm not interested in taking on long-term risk unless we're above this trend line and we're above the 200-day moving average. And so now if we move forward, um, you see what transpires. We're now underneath. And so we've made a high, a low, a lower high, a lower low. And so now we're moving off underneath, and everybody understands it. By the time March hit, we had Russia invading Ukraine. We had interest rates on the rise. And then we pop back up. We get above the 200-day moving average here, and we made a new high. So now we're like, okay, well, we got above this trend line. We got above the 200-day. So all signs are green. Well, they are until they're not. Again, look at the big green candle. Big green candle, big green candle, big green candle, big green candle. Small red candle with wicks right at a level. Super important. There's an exhaustion here. Nobody's buying here, but nobody's selling here either. That's why that candle body is so small. Okay? Bulls got trapped. Bears got trapped. This is the base of what 90% of people are trading in this vicinity. Spike up, spike back down, spike back up. The most recent spike is the one you trade, and we went green, 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 and then we stalled right here. Now, we had no idea that we were going to sell off for the rest of the year here. But we did know by the end of March with Russia, Ukraine, China doing, threatening in Taiwan, North Korea starting to fire, intercontinental ballistic missiles, just a lot of stuff going on in the globe. That doesn't change the market. Market can rise despite what's going on in the world. But what's going on in the world does matter. So now we put in another new high, and you still see the 200-day moving average. Slope was high, slope starting to neutralize itself, and then there's a little peak. So from this point, when we sell back off to the 200-day moving average, you got to do yourself a favor, and you got to draw the new line. So move the line. The line matters. And then we breached it. Okay. Usually when we get above a key level, we're going to come back and retest it, which we did right here. And we retested it down, up, back down, and then underneath. And you can see this was the last hurrah. And this is why understanding candlesticks and what they mean can help you from trading. There are a lot of people that got trapped right up here at 4,500 and are still trapped, to be honest with you. At this point, we've now made we made a recent swing high, so what we want to see is, do we make a swing low? Because at this point of this swing low, and that was 4,100, we're in trouble. I mean, the markets are in trouble. And so you see what happens over the course of the rest of this year. We made a new swing low. We didn't make a new swing high. We made a new swing low, and this was the June lows. Okay, and so from there, just looking at the candlesticks. And if you struggle here, here's the secret that we teach in ITG. If you struggle here, always flip over and pull up a Heikinashi. And the Heikinashi changes the levels a little bit, but it just gives you a glimpse of the average candle. And what you want to see on moves up that you're not afraid to take is you want to see large green candles with flat bottoms. Okay, on moves down, you want to see large red candles with flat tops with not a lot of wicks at the top. There's a green candle and a wick. You be careful here. As soon as you take out the previous low, which is right here, you would be short. And so you can day trade off of this same thing. So I don't lose too much focus. We move back. So here becomes our August highs. Now, when I'm drawing trend lines, what I typically do is this trend line held and we didn't quite get to it. This is the most recent swing high. So this point to me currently is more important than this point, even though they're off just a little bit. But you can see what's happened to the 200-day moving average, where the 200-day moving average, not only does it have a negative slope, but it has a negative slope and we're below the trend line. So for guys in ITG, we were in Hawaii during this period of time. At 4,300, we had a lot, and we got financial advisors in our group. We got hedge fund guys in our group. We had, a lot of people flip their 401ks to cash. Now, some of them didn't get it at 4,800. Some of them didn't even get it up here when we touched the first time at 4,600, because there was a chance that we were going to keep moving higher. But then once we failed it and we had this look back and this fail, there were a lot of people at 4,500 that decided to go ahead and go cash. If they missed that opportunity, again, it's easy when you look back. It's really easy to look back and go, "Oh, I should have done this. I'm freaking smartest guy on Wall Street." That's easy. The hard part is to figure out where we're going to go from here with the information that we currently have. Um, some guys went cash here, built cash up in their long-term portfolios, adjusted their 401ks. Some didn't. The ones that didn't, they were struggling down here. When we got down here and we put in the June lows, we were telling everybody, guys, if you're not already in cash, don't go now. It's a bad time. Then in August, everybody starts to get filled with this hopium that we're going to come back and go back to new highs. This is where you got to have the discipline to go, you know what? I missed this opportunity. I'm taking this opportunity. You got a negative sloping 200-day moving average, and you got a downward trend line. And that downward trend line's got two solid anchors, right? The high of the year, the March high, and the August high. And so those play out. Now look at where we are. And you see the 200 days coming back down. In the event that we have a spike up, tomorrow being Friday, early next week, where do you guys think we're gonna work to? We're gonna obviously work to this trend line. Can we get back above it? We can. Don't panic and buy. Why? Because this trend line is a cruise liner. It's a cargo container. This thing does not turn on a dime. It ain't a speedboat. It ain't a jet ski. It's a big barge, and it takes barges to get it around inside harbors and channels. So if we do spike up, guys, we're going to come back and retest this level until this starts to shallow out and climb. Okay, so that's a big thing to look at, where we are historically on the ES. Now, what I like to do is I like to go from here, and I like to work to a weekly chart. And the weekly chart doesn't look nearly as good. Because as you get to that spot, you're like, wait a minute, we've come way off. That's a big downtrend line, guys. So anybody that thinks we're just going to rush right up here and this trend line is going to become a V, you haven't been around a long time. Okay, look at the slope of the 200-day moving average, how steep it was to the upside. And then what did we do? We came down and tested it. We got back above it. It started to shallow out. We got below it. We came back above it. Hopium. Shallowed out. It bumped here. And then once we broke below it, and then it rounds off. Okay? And it forms a mountaintop, a peak, and it rounds off. The same thing's going to happen in the event that we had a bull market starting. Is it going to start? I have no idea. So here's a weekly chart. Now what I'm going to put on is I'm going to put on the weekly 200-day moving average. It's the 200-week moving average. Keep in mind, if you do a moving average on a software, TradingView or any software, the moving average is a period, and that period is going to adjust to whatever time frame your chart is. So if you trade with an 8 EMA, that 8 EMA is going to be different on a 1-minute chart than it is on a 3 or a 5-minute chart, and different on a 1-hour chart. So you got to keep that in mind. Why do I draw this? Because now we're gonna do some history lessons, okay? And the history lessons are going to go to see where does the white 200-week moving average, how does that play into the red 200-day moving average? And how do we make long-term investment decisions? 401ks, IRAs, buying leaps, planning out when to put money into long-term portfolios versus short-term day trading styles. For that, I'll throw up. It's not going to help anybody, but the weekly volume weighted moving average, you can see it's staying right inside the weekly candles for the most part. Okay, you've got daily, you've got my session ranges, intraday fib levels, intraday private, proprietary algorithm levels, weekly algorithm levels. So we've got a lot of proprietary data that we share with our ITG members. We don't share it. They have all the scripts and they work on all the indicators. But if we want to scroll out and go back and look at history, we go back to COVID and what transpired during COVID. Okay, in COVID, and again, there was a tip in at the end of 18. This is when we had rising interest rates. We dropped below the 50-day moving average. And remember what I told you, if we're in a bullish market and we don't feel like it's a bear market. Um, that was very short lived, and this is where you dollar cost average in below the 200-day moving average. Why? Because if you're buying here, and this is a weekly, so if you buy every 4 candles, and then you buy another 10%, and then you buy another 10%, you've put in 30% underneath this zone. Um, Boy, did you make some money. Here's COVID. Okay, we dropped below the 200-day moving average. So here's 1 week, 2 weeks, 3 weeks, 4 weeks. You put 10% in. 1 week, 2 week, 3 week, 4 weeks. You put another 10. You put 20% in below this level. You put 30% in below this level, at this level. Boy, those looked really good. So you don't look at the 200-day moving average and say, at here I'm going to get short. Now, at here I need to start to dollar cost average in into my levels. Now, we had no idea with COVID, how long it was going to take, if it was going to be the end of the world, um, and still don't really know much about it, much truth about it. We know a lot of people's opinions about it, but that's another video for a completely other Discord. So again, just like with this one, if you buy below it and you start dollar cost, well, I don't want a dollar cost average in when the 200-day moving average is going down. I want a dollar cost average in when we spike above it. And the reason why we spike above it is because when we spike above it, we can start to get the general trend into a positive slope. And you're looking at the slope of the general trend. Now, do you add more money down here when you're below the 200-week moving average? 100%. Look at what transpired in the October lows, and why we had such a big rally off the October lows is because we closed at the October low here. We opened at the 200-day weekly level here. We closed on it, at it, we opened at it, and then we rocketed off of it, and it went from 200 week to 200 day. So people are like, man, I really missed buying off the October lows. Why do we buy so much? Well, if firms are interested in buying the 200 day, they're 10 times more interested in buying the 200 week. It's a bigger long-term support. So let's go back to areas that we know. Let's go back to 2018. We had interest rates. We had a rise in interest rates. We actually bumped interest rates hikes. We fell below the 200-day moving average, red line, down to the 200-week moving average, white line. Okay, was this a good buy? Best buy in 10 years, from 2009 to 2020. Okay, and this is where we talk about buying when there's blood in the streets, buying into fear, not being afraid, understanding long-term what levels mean and where institutions are going to start to parlay money. Let's go back even further. Let's go back to 2016. Did we fall below in August 15? Yep, below the 200-day moving average. Did we stay below it long? No, but the slope started moving negative, and then we got above. So we had Chomp Central. So we literally, guys, went from July, August of 15, all the way until March of 16 before we started moving up. Was this a bear market? No, this was a correction in a bull market. The same with 18. The difference in 18 is that we had rising interest rates. We had to bump interest rates here, so we had a violent spike down. But look at how small the spike down were here and here. And then the spike down got even bigger here. And then in COVID, the spike down got even bigger. And now look at where we are. Even bigger. Okay, so we don't know what's going to transpire going forward. We got some ideas, but this is what I want to encourage you guys: is we go further and further back. Let's go back to my early days. Let's go back to the 200-day moving average here in the tech bubble as we're going vertical, and then we drop below it and we get back to it, and then the slope now goes. You see how we're on it, spiking up. These are huge runs. And it's just hard because of the here because of we're going so far back, and again, TradingView is not going to have that much data, but you can see that we're spiking every time. Again, I thought I was a genius, guys. I loaded up the truck every time we got below the 200-day moving average, and I traded the 50 and the 200-day moving average. man, I thought I was the smartest guy and I would, well, I thought I was the smartest guy in Wall Street at the time. And again, I created, millions of dollars, and I got extremely arrogant up here, and then we broke. And this was the first time we had broken the, significant correction since '92. I wasn't prepared for it. I had no idea. So I kept buying, and this moved back up to the 200-day moving average in 2000. This was my last hurrah, and I threw every penny I had at it. And so over the course of the next 3 years, we lost seven figures of wealth, and actually went into debt. Um, I took a job as I got certified as financial planner. I took a job as a investment officer in a firm. I had a renewed respect for risk, and this is where the Lord humbled me and taught me more about risk management, position sizing, and how to keep a broader spectrum on long-term investments. And I used to laugh at people that say they got 12 to 20% growth a year, because I was making 2,000% for 6 years. So that said, but look at what happens here. We've got and again, everybody talks about the 50 and the 200 being the death cross. The real death cross is the 200-day crossing below the 200-week. But you'll see here, we were at 1,200 on the ES, and then that crossover reoccurred back here, 3 years later at 1,100. And so, 20% lower, the market recorrected back to the upside. We had the same thing happen. Then we had this huge run, right? This is March of '03, the start of the Iraqi war. War's good for our stock market. I don't know about our economy, but boom, huge lateral, went sideways, and now you can see the 200-day is positive. The 200-week is starting to shallow, but you can see here we got above it, right? We get above the 200-week, back to it, above it, back to it, above it. And once you launch right here where the 200-day is positive and the 200-week is flat, this is where you start to buy in, and you get long, and we're up, and you get here, and this is where people start panicking, and you just buy the dips, buy the dip, buy the dip. And you want a dollar cost average in all this period. And I'm talking about your 401k. I'm talking about your IRA. You want to be getting long when we're below that level historically. So where are we now? Same thing happened in 08, 09. A housing crash. We saw it in '07. The whispers. It hit Wall Street early, just like COVID hit Wall Street early. And so we all heard about the financial crash in '07, that we had issues. Unfunded pensions, underfunded pensions, over-leveraged banks, and everybody was taking out a 80% first mortgage on their house and a 20% HELOC. Everybody was 100% leveraged on real estate, and real estate was spiking. And all of a sudden, we get below the 200-day moving average, and then you see the slope start to turn negative. And there's algorithms that are out there that, based off the slope of that 200-day moving average or the slope of the 50-day moving average, there's algorithms that can dictate percent of holdings that should be exposed to whatever index this is, and this would be the ES, so large cap growth, large cap value. Once we get below it, we get below the 200 week, we come back up, we get the death cross, and we never come back and even test the 200-day moving average, the red line. So this is Katie bar the door here. September '08, and then we're at 1335, and that puppy drops all the way to 660. 1335 here, 1500 here, 1335 at the cross, down to 600, has lost 60% of its value in a period of 6 months. This was alarming. This crushed a lot of people. When to get back in? Everybody's devastated here. When to get back in? I don't know, but when we get above the 200-day moving average and we test it and we move off of it and we start working a positive slope, I want to start putting in assets underneath this 200-day moving average. So right in here. So My thing for people is in this vicinity, when we cross right here, when we cross right here, we crossed right here. We came down to it. Once we got back above it this time, this is the kiss the channel goodbye, back above it. So if I could draw circles here, here, here. These are three places that I recommend people loading up on, 2 to 3 year leaps, if at all possible. And that's buying long-term equity anticipation, you know, products. And it's basically you're buying a call option, you're using leverage, and you're buying it with a portion of your long-term assets. So as we go back to, history, it spots where we can get long and start to really change. Guys, these dots become generational wealth positions. If you get long here at 1260, the first scare that you really got is COVID. And even at COVID, you're at 2164. So if you're buying, holding leaps from here to here, one, they don't go that far out. Warrants do, but you guys aren't going to trade warrants. But you start talking about really changing up generational wealth in your IRA, in your 401k, and then in your individual portfolio, being at a spot where you know when to take risk on. Well, reason I bring that up is if you look at the slope from the high of the year down, and we go back to where we are today, we go back and we look, where are we today? Well, we're stuck right here. Well, if this crosses underneath this one, you guys know what to do. You're gonna have to build cash in your 401ks. The reason why this one's more difficult than the previous ones is because in the previous ones we didn't have inflation. In the previous one we didn't have we hadn't already targeted 4.7, 5.25 is a prime rate. We hadn't already raised interest rates. So the last one we came out of, the financial collapse in 2009, started quantitative easing. This ended quantitative easing in this vicinity of this year. And so now they're not giving away free money, they're taking money out of the system. The government's buying back debt that was issued. Interest rates are rising, inflation's rising. And so we don't know what's going to transpire here, but I implore you to put this on your chart and really pay attention to what's going to happen between now and February. And you can see here that if we draw this line up and we draw this line down, somewhere in you can see that my cursor is January, February, March. We're either going to get back above this trend line, and the 200-day moving number is going to move higher, and the 200 weeks going to keep moving higher, or we're going to fail this 200 week. And if we do, it doesn't mean the end is the end of the world is coming. It just means that we're gonna we could have another dip below the 200 week moving average like we did in COVID. Or if we get below the October lows, and again, you really want to put a line here, because if we get below here, the next key level, if you look to the left, the next key level is that's this high. Well, what's this low area? This low area now becomes down here at this vicinity, and this is where everybody's calling 3,200. If it gets below there, where's the next level? The next level is going to be a short stop here, and it's going to be from this point, but it might be at this one. So if we go the most recent, it would be around here, and now we're at 2,900. Well, if we go below there, yeah, and so you go to this point. And again, it could be 2,400. It could be right at that, where the cross of the 200 week moving average at 2,600. It could be 2,400. It could be the one I drew from, back in December 18 at 2,300, or it could be the COVID low. Um, I don't know what it's going to be, but I know one thing, and I know you guys know it too. Wherever it is, um, it's a long freaking way down from that line. And so it's just one of those where you want to get out. Well, don't get out unless you got an idea where you're going to get back in. So if we do drop to this point, are you going to buy? You're going to start to buy. Maybe you put 10% back in. And if we don't come up, or we come up, we reject, and we move back to this line, maybe you add 20%. And then you say, you know what, I'm done adding until we're going to buy, and until we start moving higher. And then I want to buy on the way up. So, that's kind of long term. Again, you can take what you understand with candlesticks and trading, and then apply it on a bigger time frame, longer time frame, for how do you manage your retirement? How do you manage your 401k? How do you manage your IRA? How do you manage your long-term investments? And that's kind of what I was trying to throw out. Again, I didn't script it. I probably would redo this, except my wife and family probably don't want to hear me record another 30-minute video. But I hope it helps. And again, happy Thanksgiving to everyone. And we will be breaking down um, the ES in more depth, going down to a daily chart here, and putting our lines on it. So we got a really good idea as to what to expect over the next tomorrow, Friday, and then into next week. So y'all be blessed. Happy Thanksgiving, everyone. Veteran here from ITG. Peace out.